And so what we found interesting is everybody now somehow is, they recognize maybe returns are going to be lower. So they're going and investing in private equity or venture or other sort of private investments. And we're sitting and we're saying, to ourselves, okay, there is skill. Somebody who buys, a private equity skill, but you can't have, you can't have that many skilled people. And what are the challenges the investors will face in the world you are describing when they put their money in such illiquid investments?
Well, I think the first thing to know is that private equity and public equity will behave like equity. So just to be clear, it goes up, it goes down, based on the same type of factors. Private equity, if you look at the historic returns of private equity relative to the returns of public equity, they've been the same over a period of time. But although the top 20% of private equity investments have outperformed. So you have to pick the right private equity investments. And the reason, and you have to pay attention to the liquidity premium. The liquidity premium means if I compare a company that's private with a company that is public, is the one cheaper than the other? Do I have a higher expected return? Because those risk premiums change, and you can calculate those by comparing comparables. And that's a function largely of the amount of flows of capital. The thing that all investors should understand is that whatever is hot is going to get a lot of money flows. And when it gets a lot of money flows, it's going to bid up the price, because most investment managers in any of this will not say, I won't take your money. So you get these investment flows, and then there's competition. And right now, private equity is about as hot as you can get in terms of that. So almost very much be careful of whatever the hottest flavor is, because it's probably, and getting the most money, because it's probably going to be receiving too much money. So if you look at the flows that private equity's got, and you look at the liquidity premiums, there are not significant liquidity premiums. So now the question is, why should I have private equity relative to that in that kind of a setting? The disadvantages of private equity are that they don't easily adapt to changes in the world. And that's one of them. And the world changes a lot. Like Warren Buffett described when he was in, one of the things he was saying is, where won't I have the competition, those businesses that would be sort of the franchises, the safe places from the competition. And he gave an example of local newspapers, because nobody is going to go into St. Louis and build a new newspaper, so it would be. Well, the competition came from, we don't read newspapers in the same way. We go online and all the changes. And so we're in a world that is changing. And if you look at the nature of the development of businesses over a period of time, we're having these disruptive technologies. So the question is, how important is it to you to have flexibility? To me, it's very important. I want to be able to change my mind and move as I choose. I also don't like the fact that everybody's long. Okay, so let's say, what is the big exposure today? Everybody is leverage long. The whole world is leverage long. And what I mean is they're long. In other words, they're owning things that when things go, they want them to go up. They are owning equity and equity-like thing. And they're leverage long, particularly now because of the fact that when interest rates have been low in relationship to return on equities, expected return on equities, that's caused a lot of the borrowing of money to buy equity. So if you look at private equity, or even public equity, what you see is that there's been a lot of borrowing money to buy assets. In the case of the private equity, it's been through the leverage loan market and CLOs is a form of financing that to get leverage long. So the world is leverage long. I don't like to be with a crowded world leverage long, particularly at this part of the cycle. So I think it's a big bias. And I'd say, look at your whole portfolio. What is your whole portfolio like? What is going to do well, like you said, in all parts of the cycle? What's going to do well when bad comes? Because when bad comes, it's not just because your portfolio is bad, it's probably because your income is bad. In other words, the world is bad. And so that notion of how do you achieve balance without that, I think, are reasons. So all those are the reasons. I'd have to find the reason to own private equity. I could own private equity instead of public equity if the risk premiums are there and I didn't mind the lack of the flexibility. But it would be difficult for me to own private equity now. But this is, nobody wants to sell when the investment has been good. This is the thing that you've got to change your instincts, right? You've got to say, you've got to sell high and buy low. Sorry?
Easily said than done.
But even that discipline, right? It's somehow difficult to part with that thing that was doing well, right?
Ray, in relation to the answer to Hashim's question, where do you stand in relation to passive and active asset management?
I think overwhelmingly the most important thing is to get your passive right, and that means diversification in terms of asset class, diversification in terms of country, diversification in terms of currency. Because I think what most people don't understand is that markets adjust so that they're all, at any point in time, almost have about the similar risk-adjusted expected returns. People don't understand that because they think, well, this company is much better than that company. Well, because the world adjusts those prices, because if it didn't adjust those prices, then life would be easy. You would just pick all of those companies that you didn't like, and you would be short those relative to the ones that you did like. And most investors don't really somehow get that. And so as a result, all of these come up and down, and they readjust. So with that in mind, the ability to take geographic diversification, asset class diversification. Diversification, I think, is just most important. So your asset allocation mix, you know very well, your asset allocation mix will be your main thing. Then if you take out alpha, so how much active, that is alpha, it really depends on it's zero sum. So it's can you get good poker players to sit in the hand and make money and take it away from other people? And that's going to be a problem. It's going to be a problem because almost any good poker player, any good alpha manager is closed. Our pure alpha fund is closed. You can't invest in our pure alpha fund because that's the nature of the beast. And then how much can you allocate? So alpha is a very difficult game. To produce alpha is more difficult than to win in the Olympics. Because there are more people who are trying to produce alpha. The rewards are a lot better if you can do it. We put, many hundreds of millions of dollars a year into research to try to do it, to compete with others. So the most important thing is to get your strategic asset allocation mix right and to largely have it balanced, I believe.
Another question, you mentioned in terms of, in the long term, the returns for private equity is similar to public equity. So the question is really in relation to emerging market and developed market. I assume you will agree that in the long term, they are equal.
They're on a risk-adjusted basis, they're basically equal. And also, by the way, rebalancing, being diversified and rebalancing contributes to, not only reduces risk, but it also contributes to the return because you're tending to buy the thing that went down and sell the thing that was higher. Rebalancing is a good discipline in and of itself.
Another question, Ray, you touched upon raising of interest rate. How would you explain the situation now where the Federal Reserve is reducing their reserve, i.e. the banks that keep reserve with the central bank, they are reducing that amount of money? It does seem that there's contradiction in terms of raising rate and giving the money to the banks to presumably lend it. Where do you stand there?
I think that the Federal Reserve had an appropriate epiphany in terms of its monetary policy, in terms of the combination of raising rates and rolling off the balance sheet. So that was part of the adjustment. And then I think they want to keep reserves plentiful because they don't want any financial crisis. So I think that's the nature of their thinking, to keep the reserves plentiful and at the same time use interest rates in the balance sheet as their primary tools.
Ray, maybe if we can touch a bit on the currencies. So like people, they've gotten used to holding dollars, or here in the GCC, they're pegged to the dollar. Is this sort of in this world where we're entering, is it a good policy to have, given that the U.S. has all that debt?
Yeah, the dollar, a lot of the positives for the dollar are past us. I could rattle off some of them. Because the dollar is a reserve currency, it means that those want to borrow and lend in the dollar, countries, others, you all. As a result of that, it's put the United States in a position of the privileged position of being able to borrow a lot of money. And it's put a lot of dollar-denominated assets, dollar-denominated debt, in the hands of large institutions around the world and holders of that. So the world is very long dollars. Because it also is a currency that borrowing is in, a lot of countries and entities in other countries that is not their currency borrowed in dollars to invest in their local markets, to their businesses and their like. They borrowed in dollars. And as a result of that, there's been a short squeeze in dollars. In other words, if you borrow in dollars, you're short dollars. It's a promise to deliver dollars that you don't own. And so in the emerging countries, a lot, we had a dollar short squeeze. In other words, not only did they have to pay the interest rate back, but when the currency appreciates, they had to pay a higher price for dollars from their existing earnings. And so we created a short squeeze that support the dollar. If we look at what's likely to happen ahead over the next, let's say, 3 years, that's more of a dollar weakening environment over the next 3 years, because the United States has to sell a lot of dollar-denominated debt. And if we look at who is holding dollar-denominated debt, we find that they're largely very long. In other words, what percentage of their portfolio is in dollar-denominated debt assets? And it's difficult to imagine that they're going to want to increase the size of their portfolios, the portfolio share, for dollar-denominated assets in that kind of environment. In fact, we're now entering a period of time where some central banks have been selling dollars or working the dollars back at the same time as the debt squeeze is less. So I think we're going to be, if I would take a 3-year type of time horizon, that'll be a dollar weakening environment. In addition, because of the nature of the stimulation that happened, there was a hump in the demand of economic activity. In other words, the fiscal stimulation that happened was produced a hump followed by a slower amount of economic activity, which means that we're going from an environment in which the Federal Reserve was leading the tightening to an environment in which they're not going to tighten as much. And that's also not good for the dollar. So I think we'll be switching to an environment which is from bullish in the dollar to a more bearish in the dollar over that kind of time horizon for probably shorter than that, but I would be bearish on the dollar. And I think the point also is diversification of currencies. Currencies following the same thing is, if it was easy to say what currency is going to outperform another currency, then it would be easy. But diversification of currencies. The main reason that there's not so much diversification is because of that element of habit in the world is the reserve currency. Now, we're in a situation where longer term, I think we have a fiat monetary system, and all currencies have issues, all the reserve currencies. It's almost like the G7. The G7 is an obsolete concept, right? The three major reserve currencies, the dollar, the euro, and the Japanese yen, all have issues, all have problems. And so I think that also gold has to be a part of a portfolio. Gold, I don't mean a big part of the portfolio, but it should be between 5 and 10% of a portfolio, I think, maybe depending on that, because it's also a hedging asset. So if you would say, what currency would you like? And you were to include gold as a currency, I think you might think about its relative appeal. Like I think if you were to say, what asset do you think would be the safest asset and most likely to do well over a period of time? Gold would have to be one of those over the longer period.
How much of your portfolio is invested in gold at the present time? Is it 5, 10?
Me personally?
No, I mean, your alpha portfolio.
It's, I think it's probably 8 or something like that.
What about the concern about...
And what I do is, I also have break-even inflation positions. In other words, long the inflation index bonds relative to the nominal bonds as an inflation hedge. And then I have some commodities in there that make up the inflation hedge part of the portfolio.
Going back to the dollar issue. The dollar has been, of course, trade is in dollars. We sell oil in dollars. So we rely heavily on dollars. So that's why the currency is linked to the dollar. However, you see practices now by the US correspondent banks. They're creating a lot of obstacles, to clear dollars. So countries have started exploring ways to divert away from dollar.
Yes.
So either they deal directly among themselves or create a system, or even go to gold and go to medium of exchange where they have gold as a backup.
Yes.
And maybe hence that is the main reason for the increase in demand for gold.
Yes, that's right. You've seen the central, for exactly the reasons you're referring to. You've seen, for example, Russia's completely gotten off of dollars and gone to a gold in terms of backup. But you could see this in a number of cases. And sanctions have played a role in here. In other words, there's a worry, there's among some parts that if you're holding dollar-denominated debt, that could somehow become sanctioned. And the whole sanctions issue having to do with, who controls SWIFT, and the SWIFT system and all of that is a very sensitive thing because economics more is used now as a political weapon than it used to be. And so that's creating concerns because nobody wants to get squeezed. So, yes.
So I guess this brings another question where we are sort of in uncharted territories in terms of what's going to happen next. We see a lot of volatility coming. We've seen some relationships don't work sometimes. We've seen when Libya was down, oil output was down, the oil price did not go up, it went down. So there are broken relationships that we see. We have seen recently in the US, I mean, the movement towards, becoming more US focused, the issues with the trade, all of this creating a lot of volatility. So for an investor going forward, what is your advice given that this investor has to be in the market? They cannot be out of the market. They need to continue with their investment, whether they are a sovereign wealth fund, a family office, or given what we have seen so far and what is going to come, where it might be a trade, a competition, it might be technology competition, it might be various other things that will start impacting. And you will see maybe two camps, US camp and a China camp. Sorry for the open question.
It's the same answer, which is really diversify well, because it's not so much that wealth is destroyed or as much as it goes to something else. That goes down, something else goes up. It's like squeezing a balloon. And if you take that, like I'd ask, okay, how many, do you have assets in China? I mean, liquid assets? Okay, the world is underweighted liquid assets in China because it's just opened up, really in terms of liquidity. So what is your asset mix? So if you look at your history of investing, every time you move into diversification, it was a good thing, and every time everybody was cautious. I remember when I started in the investment business, and institutional investors were mostly in U.S. bonds. And then it was a venturesome move to go to having equities as well as bonds. And then it was a venturesome move to go to global equities. And then it was a venturesome move to go to emerging market equities and emerging market debt and so on. All of those moves to try to achieve balance is the best thing, because some winners probably going to produce some loser, and to create concentration, and old will be obsolete. So you have to diversify well.
What are the issues you see with renminbi?
I'm sorry?
What are the issues you see with renminbi?
With the renminbi?
The Chinese currency. Yeah.
I think the Chinese currency, the renminbi, is going to be a very good currency. And it's going to be a relatively stable currency in terms of buying power. The Chinese don't want it to be, they want it to be a reserve currency. And as we're going to the One Belt, One Road initiative, and we're having greater amounts of trade, and there's always a debtor and a creditor in it. And you don't want it to be too bad for either of them. And if you look at their balance sheet, they've got a good balance sheet. And so you'll expect that over a period of time, I think, will be a good currency. Now, what are the issues about the renminbi? As a reserve currency, you still don't have the free convertibility. So that notion of being able to move money into China and take money out of China, that's going to be a challenge. But there'll be an offshore market in the renminbi of all of the transactions going on in it. I think in that offshore market, as it grows, it'll continue to be a good market. So the currency itself, I think, will grow in importance as a reserve currency. The issue would be the nature of free capital movements.
I have a question. you said at the beginning that we should take your framework and use it to invest within our objectives. And so when you showed us the cycle clock, it kind of suggested that at this point in the cycle, the only thing that does okay is inflation-linked bonds, really. So you would tilt perhaps away from equities towards that. On the other hand, the return on inflation-linked bonds isn't very exciting, and there's nothing to stop this cycle continuing much longer than we expect. It could be, I mean, people talk about a recession in 2020, but we could continue like this for another 5, 6 years if the Fed is skilled enough to keep the growth, roughly at the productivity rate, and we can have a bit of inflation, 2.5%, 3%, and that can sustain itself for quite a while, in which case, if you're hiding in being defensive, expecting that this is late cycle, there's the old fear of missing out issue.
Yeah, so first of all, I'm not saying inflation index bonds, I didn't mean to get precise about the one of those asset classes or not. I was making the point that returns are definitely going to be very low over that period of time. I guess I never should say definitely, but returns are going to be very low over that particular period of time. And the reason inflation index bonds or nominal bonds or equities have low returns is because we have a debtor-creditor situation. And you ask, who are they going to favor, the debtor or the creditor? And right now, you want to have low interest rates. You have the burden of the debt. You're going to have low real interest rates. So all investments are being priced off of each other and going to be competitive and competing each other. Cash is a negative real return, or just about a negative real return. And then you take inflation index bonds and any of those things, they have very, very bad returns. And so all I'm saying, first of all, is in that we are in the part of the cycle where that's true. We are not going to have the benefit of an interest rate cut causing a present value effect. We're at that end of the cycle. Regarding, let's say, what growth could be, it is possible that the central bank and the central banks don't have a problem and that they get it right, as you're saying. I think it's very unlikely globally. I think if you look at the ECB situation, the maneuverability is very limited. You look at Japan's situation, look at the United States to some extent. I think that, that's an issue. But I would look at which countries have leeway. The United States has a leeway of 2.5%. China has a leeway of about 3%. But if you don't have a reason to stop it, you're not going to stop it. And it might extend out a longer period of time. I think then you have to say, how does that growth rate compare with what is discounted? So I think there's revenue growth, which is tied to economic growth, and then there's profit margins, and then there's taxes. And when I look at the profit margin picture for equities, right now, because earnings grew at a certain pace, there's a tendency to believe that that's going to continue. But in it was a profit margin expansion. And I think that you're not going to have a profit margin expansion. And so even if the revenues go, I don't think you're going to see the profit margin expansion. I don't think you're going to see the leveraging up and buying back of equities in the same form that there was the purchase of equities. And I don't think you're going to see any company tax cuts. I think we've seen the best. So those three things that were real pluses, even in an environment where we have this cycle extending, I think are risks for the equity market. So when I look at the risk and return, equity risk premiums, expected expected returns of equities relative to returns of bonds are not that much high in it. It's not very attractive. So when I look at all of that, I'd say, the picture doesn't look so good. Now, I could be wrong, but, and so for anything, for most things. So that's why I would say, if I was to make tactical bets, I would say if I was to go to some emerging countries, I think the emerging market got cheaper because there was the debt squeeze and so on. Now, some of these have bounced back, some a bit. But if you take a look, they've gotten squeezed in the dollars, they've gotten squeezed in the debt. If you look at their comparative value, like, you know, even like Russia's 5 times earnings. Or if you take India or some places like that in terms of the relative so I think that there's more opportunity, if you were going to take it, in certain parts of the world and in certain types of, you know, and both the debt and the equity market. But these are tactical bets. So I give you what I think today. The world changes. I'm not here 6 months. I'll give you a different position, and who knows if I'm right anyway. So I think the key is this element of achieving the right balance. Is what?
Always tactical. I mean, you invest in these countries. The moment interest rates rise, they apply to the center. So they suffer in terms of liquidity.
Yeah, they come in fashion,
So
they
when is
go
it
out
gonna
of fashion,
happen?
they have the
Sustainable.
movements, and you know, their expected returns, again, I would say over a period of time on a risk-adjusted basis are probably comparable. It's where there's going to be greater, I think there's going to be not only greater growth, there's efficiency impacts. Like if you look at India, and you say what you had is a bureaucracy and a terrible inefficiency, and then you say now technology is going to come to India and the whole change it's going to create. And I'm just giving, Brazil changes in terms of its squeeze and certain things. Anyway, who knows? That's the game.
Where would you place the odds of a Trump win in 2020 and its impact on the global or the US markets?
50-50. It's you know, way too early to call. Probably you have to wait till the morning after the elections to know. I mean, it's way too early to tell. But the movement and the elections will be market-driving influences, because it will be socialism or capitalism, and the probabilities will change with the polls, and so it will be a source of market volatility, I think.
Could you know, this picture that you paint of lower growth in the future and expected returns, could Europe or US, does Europe or US look a little bit like Japan in the 80s and the 90s now?
Yeah.
And in the long-term debt cycle that you talk about, whether it's short-term or long-term debt cycle, which one is closer to that?
Europe. I'm saying Europe is just about out of gas. I mean, in terms of monetary policy, and then we're dealing with the politics of Europe. We have a structural problem in the form of Italy, but also in the form of other countries in terms of like the exchange rate. So it's not competitive at this existing exchange rate. And so it's going to have stagnation. And then as it has stagnation, then it causes the credit spreads to rise. So its interest rates are higher than in other countries at the same time as its competitiveness is less. And that creates political problems as well as, you know, the whole economic problem. So, you know, Europe has less move. Europe is much more like Japan.
And in your framework, you know, when you talk about growth and inflation, and productivity is a big part of that, so productivity has come back a little bit in the US, but it's been muted. But inflation hasn't really showed up, even though you've had 10 years of steady growth and monetary policy and now fiscal stimulus at the end of the cycle. So where is inflation, and what's keeping it where it is?
I gave the it's the amount of spending divided by the amount of goods sold. And so what's happened is that the amount of money that has been produced has increased a lot relative to the amount of credit that has increased, which hasn't been much. And then there's also been the digitalization of the economy and globalization, but particularly also digitalization. The whole idea of capacity constraints is a different concept in a digital economy, because you can turn that on. You don't have a bottleneck. You know, if you have a digital business in any way, you can just produce it and you don't have a bottleneck in the same way. That digitalization. So if you look at the breakdown of inflation, we have steady goods deflation. Goods have deflated on a consistent basis, still are deflating. And so if you look at that breakdown, so the real question is that bottleneck, how that bottleneck will play a role. And the bottleneck of labor connected to inflation is very muted. So I agree in terms of the notion, like the inflation problem. I don't know what all the worry about the inflation problem is. I think it's very much an exaggerated worry. I think central banks are thinking about, have thought about it in an old world type of way, where, you know, like they said, the Federal Reserve people, and they say, oh, well, I don't understand why inflation hasn't picked up. It's actually not difficult. If you look at the individual components of inflation, you know, what is goods and what are the types of goods and what are the services and types of services. Their idea that inflation is going to pick up is very heavily tied to the notion of, like, when you have the capacity constraints and unemployment, unemployment rates are low, and then you're going to get wage inflation. But even wage inflation is going to be somewhat tepid. So I think that the inflation, there has not been a really good reason for inflation to accelerate. I think the risks are asymmetric on the downside. You know, just watch. If inflation picks up and you're really worried about it, put on the brakes. But what you should worry about is if the economy turns down and you don't have as much ammunition, and then you have this political polarity, that's what's to worry about, I think, on a downturn. So, yeah, I'm not as concerned about inflation, unless there's monetary inflation. I think you could see monetary inflation at some point, and it's going to come first through the currency, and that becomes the interesting. We will be around when that becomes an issue with the dollar. I do believe.
I think maybe one of the explanations that we didn't see inflation in products and retail market, etc. We have seen it in the financial markets. So the question is really, what will be the impact if there's a deflation in the financial markets on the real economy and on inflation at that stage?
Well, as you know, if the financial markets go down, then, of course, people's collateral goes down, people's assets that, people's sentiment goes down, lending shrinks, losses occur. There's a self-reinforcing cycle. I did a debt cycle book.
We have it outside.
Okay, there's a debt cycle book, and you know, and that produces that kind of reinforcing cycle until there's enough liquidity brought in, and so it's a dangerous situation, because if you have that happen, collateral goes down, and then you have a limited capacity by central bankers to deal with that. I honestly don't know what Europe would do in that kind of a situation, you know, what new type of quantitative easing. So, yeah, no, it would not be good if financial asset prices went down much.